Okay, we are going to go now to the trading floor of the Chicago Mercantile Exchange as we look at how the markets are reacting to the GDP numbers. Joining us now is Scott Bauer. He's Senior Market Strategist at Trading Advantage. Scott, thank you for being here with us.
Pleasure. How are you?
I'm well, thank you. What is your read on these numbers, these better than expected GDP numbers in the United States?
You know, they are better than expected, but take a step back. We had this 1.8 number for first quarter that just got revised down to 1.1, and initially that number was well over 2%. So now we see this 1.7 in the second quarter. I think there remains some question, though, as to whether that number is going to get revised down, you know, when we get the report next quarter. Now, albeit this is good news, it's not a blowout number. The ADP number this morning, which came out, was better than expected, but ADP hasn't been, you know, so consistent and so, let's call it, spot on in their last couple reports. I think Ben is going to be extremely, or the notes are going to be extremely, let's say, tight later today. He's not going to hint at anything. I think Friday is really the big tell-all. This number that comes out Friday. And if we get a strong number such as ADP is suggesting, we may see a market sell-off, just like what your guest is saying. You know, good news right now may not be such good news. And so even though things in the economy may start looking upward, number, and it's good that the jobless number is low and claims are coming down, but the market doesn't necessarily want to see that. So, you know, I think it's really a catch-22 scenario right now. Good number this morning, but I think there's some caution there because of what we saw in the first quarter revision, a major downward revision. You know, maybe that's going to happen with this one too.
Scott, John here. Great point that you make with regards to the negative revision, and I think maybe that's one of the reasons that's causing this uncertainty because, as I mentioned before, you had a lot of the ADP or the employment, the non-farm payroll numbers come out over the last couple of months that have been positive revisions upward that have acted as a tailwind. But, you know, if we're playing this game of poker right now, what would you say has got a higher trump value? The non-farm payroll, the ADP, or the GDP numbers that just came out?
Well, I'm going to take the easy way out on this one. Since we didn't have much of a market reaction just now, I'm going to say the non-farm payroll number, which I think really everyone is keying in on. And you know what? It's almost somewhat unfortunate that this is what we're really keying in on when we're right in the midst of earnings season. You know, we're almost over, and overall, earnings have been pretty positive. Not blowout, but they've been pretty positive. So at the end of the day, you know, we have to look at these S&P 500 companies. We have to look at corporate growth and say, okay, from that perspective, are things getting better? And from there, they really are. But, you know, I think the next big number really is going to be Friday. I don't think Ben's going to say anything today that's going to tip a hand one way or the other, whether QE is going to start tapering back in September or first quarter next year. You know, it's going to be, these are the benchmarks we're looking for. We're looking for inflation, you know, around that 1.5% number. We're looking for, you know, unemployment somewhere between 7 and 7.5 or under 7%, let's say. And he's going to leave it at that. You know, everyone's going to be just scrutinizing every single word that he says today. We're not going to get out of it. We'll see what happens on Friday.
Scott, another question for you, just with regards to, you know, with the earnings season, the last two seasons, this earnings season in the U.S. is almost done. But, you know, basically what I've seen so far is that the top line of most companies has basically missed by a little bit, and that's kind of like a good corollary to what's going on with, say, U.S. GDP numbers. So if that number can't be substantially above 1%, once again, it begs the question, how can you generate material earnings growth for the rest of the economy if you can't really grow the top line anymore? Do you have any worry about that going forward?
I do, and here's the reason why. When you look at bottom line growth, you know, that's actually been pretty good. And the reason being is because companies are much more streamlined now. They're getting more with less. They're not hiring as much. You know, that's why the unemployment number is still up there. So they're really, the bottom line revenue growth is really coming from cutbacks in the company. Not so much because of that top line, like you said, but it's really because, you know, the expenses going in, namely salaries and the number of employees, that's what's being cut back. So there, to me, is the concern. So even though those numbers have been good in that revenue growth and that bottom line, that one is somewhat shady as well, because what you want to see is you want to see more employees. Obviously you want to see the job growth, and that's what we're not seeing, and that's what's going into that bottom line number.
Thanks a lot, Scott.
My pleasure.
Have a good day. That was Scott Bauer. He's Senior Market Strategist at Trading Advantage in Chicago.